the market's to a church with a casino attached, and people can move between the church and casino, and I would say there are more people in the church and more people in the casino, but the casino's gotten very attractive to people. You know, if you're buying one-day options or selling them, I mean, that is that's not investing, it's not speculating, it's gambling.
Bubble burst first because they needed cash.
People are waking up thinking, where's the market headed next? Has been this question of an AI bubble.
What to do during times of extreme stock market overvaluation? What to do when you feel bearish on a stock? Or you might feel bearish on the whole stock market? Well, that's what we're gonna cover today. There are ways to position yourself during times of extreme overvaluation of the stock market. I truly believe that we are currently, at the time of this recording, which is early June 2026, in uncharted territory of stock market overvaluation. No matter what anyone says. With the Buffett indicator and the Shiller-Cape ratio at levels not seen since the 1929 recession or the 2000 dot-com bubble or even the 2021 market hype, I truly believe that we are on the verge of a cliff for the stock market. Now, if you feel bearish on an individual stock, or you might even feel bearish on the whole broad market, what to do? What are you going to go about? How are you going to position yourself? Well, there are several things that you can do, and we're going to cover in this video. The first thing that is an option, but at the same time is, in my opinion, the last resort, and is the last thing that you want to do, is selling a stock short. Number two, you can buy a put option. Number three is a credit spread. And number four is to buy an inverse ETF. So that's what we're gonna cover today. This is gonna be a comprehensive guide, especially focused on short selling. So we're gonna talk about what to sell short, when to sell short, and how to sell short. So I hope I got your guys' attention, and stay tuned up until the end of the video. Selling a stock short is essentially the inverse of traditional investing. Instead of buying low and selling high, you are trying to sell high and buy low. It is a strategy designed to profit from a company's decline or a broader market correction. Because short selling flips the mechanics of a standard trade, it carries unique operational rules and structurally higher risks. Now, what does it mean and how to do it? When you short a stock, you are selling shares you do not actually own. To pull this off, your broker acts as the middleman in a multi-step process. Basically, your brokerage firm borrows shares of the target company from another investor's margin account or from an institutional lender's inventory. The borrowed shares are immediately sold on the open market at the current market price. The cash proceeds from this sale are deposited in your account as a collateral. You maintain the position while monitoring the stock. During this time, you are responsible for paying any dividends the stock issues and a borrow fee to the lender. To close the position, you buy the same amount of shares on the open market, ideally at a much lower price, and return them to the lender. Your profit, of course, is the difference minus the fees. For example, if you short 100 shares of an overvalued company at $100 a share, you collect 10 grand in cash. If the price drops to $60, you spend 6 grand to buy those shares back. And you return the shares, netting a $4,000 profit, minus, of course, the borrowing fees. Now, when you buy a stock, your downside is capped at 100%. the stock goes to zero and your upside is infinite. But when you short a stock, your upside is capped at 100%. The stock goes to zero and your downside is infinite because a stock's price can technically rise forever. Now, what are the green flags to short? The company's fundamentals. Shorting a company simply because its price to earnings ratio looks high is a frequent trap. Expensive stocks can easily become more expensive. Experienced short sellers look for structural cracks in a company's foundation, such as deteriorating cash flow versus net income. A classic red flag is a company showing positive accounting earnings on the income statement while its free cash flow is deeply negative. This indicates aggressive revenue recognition or uncollected bills. Look for companies with high leverage, which means debt to equity ratios significantly above industry averages, whose corporate bonds are maturing soon. In a higher for longer interest rate environment, refinancing that debt will drastically spike their interest expenses and crush margins. Companies that can no longer grow organically often buy smaller companies to aggregate revenue. This has a dying core business and builds up massive goodwill on the balance sheet that will eventually face heavy write-downs. Next, if executives are aggressively offloading shares via unscheduled sales while public PR remains highly optimistic, it signals a disconnect between corporate narrative and internal reality. Also, pay attention to the broader market conditions. Individual companies rarely fall during an aggressive, liquidity-driven bull market. Successful short campaigns usually require the wind at their back from macroeconomic shift. The market metric. Let's look at the setup for shorting against the current context in 2026 at the time of this recording. The Shiller PE ratio, better known as the CAPE ratio, it measures the S&P 500 price relative to the 10-year inflation-adjusted earnings. Readings above 35 historically imply stretch valuations and lower forward returns. Now, in 2026, the CAPE ratio is nearly 39. Historically rare territory matched only by the 1999 tech peak and late 2021. Next, liquidity and central bank policy. The setup for shorting. Quantitative tightening, QT, or central banks pausing interest rate cuts reduces the excess capital floating in the financial system. The current context in 2026. Tightening. Major central banks remain cautious, keeping interest rates elevated to combat sticky energy and supply chain inflation, which drains speculative liquidity. Last but not least, market breadth. The setup for shorting. If the market index is hitting new highs, but the number of individual stocks advancing is shrinking, leadership is dangerously narrow. The current context in 2026. Highly concentrated. The market is highly concentrated. A massive percentage of index gains has been driven by capital expenditure into AI infrastructure, leaving broader consumer-facing sector vulnerable. Next, before executing a short position, you need to run an operational checklist that goes beyond basic security analysis. Check the borrow fee and availability. Highly shorted stocks are deemed hard to borrow. Brokers charge an annualized interest rate borrow fee to short them. If a stock has a 20% annualized borrow fee, the stock has to drop 20% in a year just for you to break even. Next, analyze the short flow percentage. The short flow is the percentage of available shares currently shorted. If this number is above 15 to 20%, the stock is a crowded trade. Any unexpected positive news can trigger a short squeeze, forcing short sellers to panic buy shares to cover, causing an explosive upward move. Identify the near-term catalyst. Being right too early is functionally identical to being wrong when shorting. You need a specific upcoming event, such as an earnings report a regulatory ruling, a patent expiration, or a debt maturity deadline that will act as the forcing mechanism to reprice the stock. Now, what kinds of companies are historically good to short? Short sellers generally avoid robust, cash-flowing industry leaders and instead target specific profiles. Structural decliners. Secular headwinds. Companies whose core business models are being slowly hollowed out by technological shift or changing consumer behavior. For example, traditional linear media platforms competing with streaming, or legacy brick-and-mortar retail lacking a digital moat. Pre-revenue, speculative hype. Companies trading entirely on forward narratives rather than current fundamentals. When capital becomes expensive, businesses that promise profits 5 to 10 years out see their valuation multiples compress fastest. Fat-driven businesses with low barriers to entry. Companies that experience a temporary gold rush due to a sudden consumer trend, but possess no proprietary technology, cost advantages, or switching costs to stop competitors from replicating their margins. Risk mitigation alternatives. Because direct short selling features unconstrained risk and ongoing borrow costs, many investors prefer defined risk alternatives to express a bearish view. First one, buying long puts. Purchasing a put option gives you the right to sell the stock at a set price. Your maximum loss is strictly limited to the premium you paid for the option, eliminating the risk of an infinite upside squeeze. Next, the bear call spreads or the credit spreads. This involves selling an out-of-the-money call option and buying a further out-of-the-money call option. It allows you to collect premium and profit if the stock stays flat, drops, or even rises slightly, while strictly capping your maximum loss. Or you can buy a reverse ETF. You see, when you buy a standard invert ETF, your maximum loss is strictly limited to the cash you put in. If the market aggressively rallies against you, the ETF can drop to zero, but you will never face a margin call or owe money to your broker. The other advantage is that you don't need a margin account or you don't need to pay borrow fees. Direct short selling requires a margin account and subjects you to fluctuating daily borrow fees, which can skyrocket on highly shorted stocks. An inverse ETF bypasses this. You can buy it in a regular brokerage account and even certain retirement accounts without needing special short sale approval. It avoids the short squeeze. Because you do not owe physical shares to a lender, you cannot be forced to buy back and close your position at an artificially inflated price during a short squeeze. But there is a catch of the inverse ETF: the volatility decay or the beta slippage. The biggest and most common trap with inverse ETFs is assuming they are a long-term buy and hold vehicle. You see, most reverse ETFs, especially leverage, like 2x or 3x, are engineered to track the daily performance of the underlying index, resetting every night. Because of this daily rebalancing, a mathematical phenomenon known as volatility decay or compounding drag will slowly erode your capital if the market moves sideways or is highly choppy. Well, I thought this was helpful. I feel like I'm gonna wrap this one up here, and let me know what you guys are doing. Are you guys shorting? Have you ever shorted a stock before? What is your sentiment on the broader market? Do you feel it's overvalued? Anything, guys, feel free to reach out. You got comments, questions? What do you think I need to talk about next? I'm here for you guys. Peace out.